Today we're going to tackle a question that is on a lot of people's minds right now. Can you still make money in real estate in 2025? If you've been wondering about property and whether it's still worth it, or if the market's just too crazy right now with the prices, you're in the right place. We're going to break this down step by step, and by the end of this video, you'll have a clear framework for evaluating whether real estate investing fits your overall wealth strategy. Here we go. When it comes to building serious wealth, there are really three main vehicles that you can take. The first is capital markets, which involve stocks, bonds, and alternative investments. Long term, the S&P 500 has averaged about 9 to 10% annually. Then there's real estate, which involves residential and/or commercial property. Historically, residential real estate has returned around 3.1% per year, and commercial has averaged closer to about 6.5%. Business ownership is third. Business ownership is like startups, acquisitions, or franchises. Established businesses like franchises or acquisitions often fall in the 5 to 20% range. Startups are much more volatile. Many of them fail completely, while few can deliver outsized returns of 50% or more in a single year. At first glance, real estate might look like the slowest path by these numbers. But here's the thing, real estate plays by a completely different set of rules. Unlike a company or stock, the value of real estate is anchored in physical property. That means a house or a building has inherent utility. It's not a means to an end, it is the end in itself. It provides shelter. While there are intangible benefits too, they aren't primary. Its value is more tied to its immediate pragmatic value rather than those intangible factors like brand, goodwill, organizational efficiency, supplier relationships, or even company culture. The next thing about real estate is that it's highly leverageable, meaning you can control a large asset with a relatively small down payment. That's because the bulk of its value is in its immediate ability to shelter, and banks know that. There's unarguable value there, and it isn't going away unless there's some sort of extraordinary and permanent natural disaster. It's also tied to interest rates. Long-term borrowing costs shape both price and profitability. And it's influenced by economic cycles, especially housing demand, inventory, and mortgage availability. The real superpower of real estate, though, is the combination of tangible value and leverage. Think about it. A home you buy can shelter you or a tenant just as well in 20 years from now as it can today. Unlike a company that could become obsolete overnight, that property retains practical value. That's why real estate is often less volatile than the stock market. But, and this is the key, you add leverage and the math changes dramatically. Let's walk through an example. Imagine that you buy a $200,000 investment property with a 20% down payment. That's $40,000 from your pocket. If housing prices rise just 3% in the first year, your first year return on that $40,000 investment could jump to 15%. For now, we're ignoring taxes and transaction fees for simplicity, but 15% sounds amazing, right? But here's the flip side. If property values fall, let's say 5%, your $40,000 equity could drop 25%. And if the property rises 11%, you're looking at a 55% return. Leverage magnifies everything. That's why real estate can outperform stocks, but can also underperform them by a wide margin. More risk for more potential return, as is the case for nearly everything related to investments. So how wild can housing prices get? When most people think of volatility, they think of the stock market, prices swinging wildly day to day. Housing feels a little bit more stable in comparison, but it's not immune. Economists measure swings using something called standard deviation from trend. Basically, how far do prices wander from their long-term growth path? Here's what the research shows. Across multiple countries, prices typically wander about 15% from trend from year to year. Even a 20% swing in 1 year isn't unusual. Extreme cases, which would be like 3 standard deviations from the average, can mean nearly 50% moves one way or the other. Now, in the US, historical housing volatility is lower than average, around 8%. But other countries like Japan have seen swings as high as 48%. Now, there's 2 important caveats here. Volatility varies widely even within a country. So San Francisco and Phoenix, for example, might as well be worlds apart. And big bubbles can temporarily change volatility. That's why it's important to look at both long-term trends, but also not ignore the recent history. The takeaway here is that housing is cyclical. It doesn't usually whiplash like tech stocks, but swings do happen and you need to plan to navigate them. So here's the current landscape. Median US home prices are 5.3 times the median household income as of 2023. That's up from 3.2 times the median household income in 1970. So affordability is a real challenge. This isn't necessarily a bubble though. It's largely supply and demand. There are far fewer entry-level homes being built today, which is defined as 1,400 square feet or less. Construction costs are up, partly due to the supply chain disruptions during the 2020 shutdown, which were resolved but never returned prices to previous levels. And then higher interest rates discourage homeowners from selling, which keeps inventory even tighter. But even with these challenges, real estate can make sense if approached strategically. Let's look at how investors can approach property today. Investor A puts 20% down. To balance leverage risk, it's important that he ensures his stock portfolio equals at least the mortgage balance. In other words, if his mortgage is $160,000, he should have at least that amount saved away into other investments, including his retirement accounts, to maintain proper diversification of risk. What about Investor B? Investor B puts 50% down. She diversifies similarly, ensuring that she has the equivalent of the mortgage balance saved away into her other investments, effectively balancing risk across assets. And then there's Investor C, who decides to buy 100% in cash. Diversification still matters here, but the exact strategy is driven by the investor's risk tolerance and need for liquidity. In other words, in my opinion, an investor should not buy rental property unless he or she technically has total investments equal to the price of the property. If they're buying a $200,000 home, they should have $200,000 saved. 20% of that might go toward the down payment, but the rest should remain diversified across other assets, including the retirement account. This helps keep leverage from wrecking their financial plan if volatility strikes. Regardless of approach, keep an emergency fund with 3 to 6 months of living expenses plus monthly housing costs. So, what should we expect looking ahead? Forecasts suggest that US home prices may grow anywhere from 2 to closer to 3.5% annually through 2030. This is modest on its own, but add rental income and leverage, and returns can become quite meaningful. Remember, forecasts aren't guarantees, but they do help anchor expectations for planning in the present. Real estate also makes a great diversifier. Even though it's leveraged and volatile, it often moves independently of the stock market. This mix can help actually smooth your overall risk-return profile. In summary, before buying, don't just ask, can I afford this property? Also ask these 3 other questions. How much leverage am I using? Is it 10%? 20%? Maybe you're buying 100% in cash. How does leverage amplify both potential gains and losses? And do I have at least an amount equal to the mortgage invested elsewhere to diversify risk? If a 5% drop in value means a 25% loss in your investment, are you prepared? If not, adjust leverage or save more before buying. By running this simple test, you approach real estate with clarity, confidence, and a plan, keeping your overall wealth expedition on track. So, can you still make money in real estate in 2025? The short answer is yes. If you understand how leverage works, you plan for volatility, and use real estate strategically as part of a diversified portfolio. If you found this video useful, hit like, subscribe, and even share with a friend if you know someone who might benefit from its content. And be sure to join the weekly newsletter as well over at thewealthexpedition.com. Thanks for watching, and I'll see you next week.